Okay, so you've probably seen the headlines, right? Gold, silver, prices are surging. But beyond the flashy numbers, what does that actually mean for you, for your wallet? Well, in this explainer, we're going to connect those dots and look at how precious metals tie directly to your everyday expenses. So really, why should you care about the price of gold? I mean, that sounds like something for Wall Street traders to worry about, not for the rest of us. But here's the thing. As we're about to see, it's a signal that hits way closer to home than you might imagine. To put it simply, a gold surge is a massive warning sign. History shows this pattern playing out over and over again. A big jump in the price of precious metals is almost always a preview of higher prices for groceries, for gas, for all your essential goods. Okay, so how does this actually work? How can gold be this early warning system? What is the market seeing that maybe the rest of us are missing? Let's dive in and break down the signal it's sending. And this right here gets to the absolute core of it. You see, in the financial world, gold isn't just some shiny metal. Nope. It's an asset that's always looking ahead, trying to price in the future. So when you see investors rushing into gold, what they're really doing is placing a bet that the purchasing power of currencies like the dollar is about to go down. So what makes them place that bet against paper money? Well, it's usually a combination of these big picture factors. Things like central banks easing up their policies, or governments running huge deficits. They all signal that more money is about to be created, and that can make each dollar you have worth less. This is exactly what sends investors looking for a safe haven, and historically, that safe haven has been gold. But here's a super important point. This market signal, it doesn't translate into higher prices at the grocery store overnight. There's a delay, a predictable and absolutely crucial time lag between what the market does and what your wallet feels. This process almost always unfolds in three phases. First, you get asset inflation. That's the gold and silver rally. Then, after a delay, it could be 6 months, it could be a couple of years, it broadens into commodity inflation, which hits things like oil and raw materials. And then finally, it hits home for all of us in phase 3, consumer inflation. That's when the price of everyday stuff starts to climb. So why is there a delay? It's because financial markets and the real economy are on totally different clocks. Markets react in a flash to news and what they think will happen. But the real economy, farmers, manufacturers, retailers, they're bound by existing contracts, supply chains, and inventory. A farmer can't react to a market signal overnight. They're tied to planting and harvesting seasons set months ago. And make no mistake, this is a pattern we've seen again and again. You look at the 1970s, a massive gold surge was followed by crippling stagflation. In the 2000s, another gold rally came right before the food price crises of 2008 and 2011. And now, in the 2020s, we're seeing that same playbook run again. First the gold surge, then the rise in energy and living costs. Now, I want to be really clear about something. This isn't about predicting some sudden overnight hyperinflation where money becomes worthless. The real threat is way more subtle. It's a slow, steady, grinding increase in the cost of living. It's the kind of inflation you barely notice day to day, until one day you wake up and realize everything is just so much more expensive. And those prices aren't going back down. So if a gold surge is the alarm bell, what's the response? How can you actually prepare for the kind of environment that usually follows? Let's walk through a practical defense plan. The first step is to kind of rethink what gold is for in a portfolio. Its main job isn't to generate explosive profits. Instead, you should think of it as a defensive anchor, a tool to preserve the purchasing power you've already built. A pretty common recommendation is to allocate somewhere between 10 to 25% of your assets to precious metals for this very reason. So here's what a balanced defensive portfolio might look like in a time like this. You've got precious metals to preserve value, but you still need growth assets like stocks to try and outpace inflation. You'd also want some exposure to strong currencies and bonds, and just as important, something we're calling a real-life defense. So what's that include? Because this isn't just about financial assets in a brokerage account. You can build resilience right into your daily life. Securing a fixed-rate mortgage locks in your biggest monthly expense. Stocking up on non-perishable foods insulates you from future price hikes at the grocery store. And holding some tangible assets outside of the banking system, well, that provides a buffer against any stress in the system. These are practical, real-world hedgers. So, after all of that, what's the core message here? If you remember just one thing from this entire explainer, what should it be? It really all boils down to this powerful idea. In an inflationary world, the very nature of saving changes. Simply holding on to cash could mean a slow but steady decline in your wealth. Owning real, tangible assets, whether that's gold or property or a piece of a productive business, that becomes the primary way to protect yourself. So we'll leave you with this final thought to chew on. A surge in the price of gold isn't just news, it's a signal. And the real question you've got to ask yourself is your strategy ready for what that signal says is coming next?